Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this Wednesday, March 18th, 2026. We've got a busy show for you today, packed with insights from yesterday's market activity.
Indeed, Ethan. We saw a significant increase in user discussions and flagged stocks. The data analysis for March 17th, 2026 certainly kept our AI busy. It seems the market sentiment is a bit mixed, presenting both some promising leads and some really high-risk scenarios.
All right, let's jump right into it. First up, we're looking at Nebius Group, or NBIS. This stock saw a massive surge in posts, over 100, which really caught our attention. On the positive side, they've announced huge deals recently, like a $27 billion Meta AI agreement and a partnership with NVIDIA. That to me screams growth potential, fueling their push into AI infrastructure.
Well, Ethan, while those deals sound impressive on paper, our AI-generated insights paint a very different picture. The community sentiment around NBIS is overwhelmingly bearish. Many users are accusing the company of a pump-and-dump scheme, especially after they announced a $3.75 billion convertible senior notes offering right after these big deals. When you look at the KPIs, the alarm bells really start ringing. Their price-to-earnings ratio is an astronomical 969.4, and they have a negative operating margin. That tells us they're losing money on their core operations, and the stock is grossly overvalued based on current earnings.
You know, I hear you, Brooke, but these are long-term infrastructure plays. They need capital for that huge CapEx-intensive infra, as some users pointed out. The partnerships themselves could transform those margins over time.
They could, Ethan, but the debt-to-equity ratio is also very high at 105.9. That's a lot of leverage for a company that isn't profitable. Given that we previously classified NBIS as a speculative gamble yesterday, and the sentiment has worsened so dramatically with these concerning financial metrics, our analysis suggests a downgrade. So the final verdict for NBIS, based on this market commentary? For NBIS, it's a clear stay away. The financial risks and market skepticism outweigh the future growth promises right now. Moving on, let's talk about Toast Inc., or TOST. While the post volume wasn't as high, there was a compelling bull case presented for this restaurant tech leader. They're expanding with new partnerships like Teriyaki Madness. I see a solid company carving out a niche in a growing sector, and Wall Street still seems to have bullish views on it as a growth stock. Plus, insiders are buying, which is always a good sign of confidence.
I appreciate the optimism, but the data analysis indicates a bearish sentiment among general users. The biggest concerns are the challenging restaurant industry environment and the fierce competition. That original bull case was quickly challenged, with users highlighting a tough industry and questions about the sustainability of growth. The PE ratio is still high at 50.7, implying significant future growth that many doubt will materialize. And, a beta of 1.95 means it's super volatile, especially if the economy gets rough, which many users are predicting. But the insider buying, that's almost 3% of total insider shares purchased. That's a strong vote of confidence from people who know the business best. It is a strong signal, I agree, but it's not enough to overcome the fundamental risks right now. High PE in a challenging sector with slowing revenue growth and high volatility just screams caution. We had Toast as a stay away back in November, and despite some positive news, the core financial concerns and market sentiment haven't shifted enough for an upgrade. All right, so for Toast, stay away for now. Too many headwinds and valuation concerns. Okay, next up, Hims & Hers Health, HIMS. We saw some significant activity around this one, driven by a big investment. They've got strong revenue growth, nearly 28%, and they're making smart strategic moves like their partnership with Novo Nordisk and expanding into GLP-1 weight loss medications. That's a huge growth market. And talk about insider confidence. Insiders have purchased over 43% of total shares held recently. That's massive. Ethan, that insider buying is impressive, truly, but we can't ignore the incredibly high debt-to-equity ratio of 207.16. That's a substantial amount of leverage, making the company very sensitive to market shifts or competitive pressures. While revenue growth is strong, the PE ratio is still close to 49. That means a lot of future success is already baked into the current share price. User sentiment, despite the big investment, suggests a perception of overvaluation and viewing it as a high-risk gamble. They're worried the stock is peaked. Hims was a speculative gamble just yesterday, but with that extreme debt and the high expectations, the risk profile has intensified.
So even with the strong growth and insider buys, the financial structure makes it tough?
Exactly. The potential is there, but the current risk-reward balance is just too tilted.
And the final word on Hims?
Stay away.
The debt burden and high valuation make it too risky for now, despite the strategic moves and insider confidence.
All right, so that brings us to our roundup for today's candidates.
It was a day where caution really dominated our AI-generated insights. Investigate as buy? None. Investigate as cautious buy? None. Investigate as speculative gamble? Hims and Hers Health, HIMS. And that's our deep dive for today. Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you tomorrow for more insight.